If you want to invest 10 lakh rupees today, how would you go about it? In this video, I'm going to give you 3 battle-tested strategies: starter, balanced and aggressive. And by the end of it, you'll know exactly which is the right one for you. 10 lakhs invested in these strategies would have grown up to 47 lakhs in just 10 years while managing your risk. I've been licensed in Indian financial services since 2015 and I've used this exact playbook to help hundreds of clients. With that being said, let's get started with the starter strategy. This is designed for someone who's never really invested meaningful amounts of money in the markets and they want to build wealth without losing sleep. And that's the critical part, right? You want to get good returns, yes, but while managing your risk. Here's your exact 10 lakh blueprint. 6 lakhs gets invested in a balanced fund, 2 lakhs in a mid-cap fund, 1 lakh rupees in international funds, and 1 lakh rupees in gold. Before I share the logic behind this exact allocation, this particular portfolio would have grown to about 42 lakhs in 10 years versus the Nifty 50, which would have grown to about 35.5 lakhs. Now, why does this strategy work so brilliantly? That 6 lakh rupees that you're investing in balanced funds is the perfect way to start. Because in these funds, when the markets are overpriced, the funds automatically shift to bonds. The fund manager does that. When there is a potential crash, these fund managers load up on discounted stocks. You don't have to make any of these decisions, don't have to worry about timing. The fund does that and that's the fund manager's job. Then your 2 lakh mid-cap mutual fund invests in companies that have been ranked between 100 and 250 in terms of size in the Indian stock market. This gives you some kicker of growth and some flavor of what it is like to invest in potentially high growing companies, and this will come in handy as we go along. Then the 10% international exposure protects you from India-specific shocks and disasters. Do you remember demonetization? Global funds at that point weren't affected by it, they barely blinked, while the Indian stock market kind of became a little shaky. At the same time, the rupee has depreciated by around 4% on average against the dollar every year for the past 3 decades. So if you're investing in the US markets, let's say, and those markets give 0% returns, by merely rupee depreciation, you get 4% returns. If that market gives 12% returns, you've got 12 plus 4, which is 16% returns. And then there's finally gold, right? We are investing 1 lakh in it. It's again a wonderful way to add some kind of stability to your portfolio, because usually when the stock market is not doing well, gold tends to do well. And when the stock market is doing well, gold does not tend to do well. The last 1 year is a classic example. The Indian stock market, which is, I'm considering the Nifty 50 here, has actually gone down by 2%. But at the same time, gold, guess what, has risen by over 45%. Now, in terms of different assets, the amount that you're investing here in balanced funds, right, 6 lakh rupees, about half of that, that is 3 lakhs, potentially gets invested in bonds, which becomes the safety part of your portfolio. So if you sort of zoom out, you realize that you are investing about 25-30% of your money, or 2.5-3 lakhs in bonds, about 1 lakh, that is 10% of your portfolio, in gold. So over 1/3 to 40% of your portfolio is not getting invested in stocks. And the remaining 6.5 lakhs that gets actually invested in stocks, about 4 lakhs is going into India's largest stocks. So think of Reliance, HDFC, TCS, Infosys and the likes. And the 2 lakhs, right, that are remaining, that goes into mid-cap funds that are potentially the bigger companies of tomorrow. So you're balancing across different assets. Even within the stock market, you're diversifying your money between different types and sizes of stocks. Here's a quick depiction as to how this portfolio has performed in the past 15 years. So if you notice, I have currently highlighted this exact mix or the portfolio that we have, and I've compared it against the Nifty 50. And you will see right away, right, that almost at every instance since the last 15 years, this portfolio has done better on a 5-year rolling basis compared to the Nifty 50. There was a very small window right here, right, late 2021, when for a very short amount of time, the Nifty for a few months was ahead of this portfolio. And the more important aspect here is the 5-year median rolling return. And that's how you got 10 lakhs invested growing to over 42 lakhs in this portfolio, and in the Nifty 50 that would have grown to about 35 odd lakhs because it's growing at 13.6%. That is the difference of 2% higher returns over a 10-year window. And what's even more insightful here is the standard deviation. Think of it as the risk that you're taking on. I won't get into the technical definition of it, but just think of it as a measure of risk. You will see that it's very similar, right? 3.74, very, very similar. So you're taking a similar risk, but you're getting 2% higher returns. And that is because of the way we are diversifying our money across different assets. At the same time, just look at how many times this portfolio has given over 20% annual returns across a 5-year period. It's 17.5% for this portfolio and just 3.5% for the Nifty 50. And I know here that the Nifty 50 is not a direct apples to apples comparison, because in our mix we have some bonds, we have some gold, we have some mid caps. Majority of the stocks are going into large cap stocks, but I'm just giving you a comparison of how this would have done against the Indian stock market if you'd only invested in India's largest companies. But here's the real power of this particular strategy. It helps you build your investing confidence. 1 year from now, when you see how this particular portfolio would have behaved during market ups and downs, you'll be ready to invest bigger amounts with conviction. So if you're starting out, your goal should not ideally be to maximize returns. Yes, they're important, but it should be to develop the confidence in yourself and the process of investing. On Saturday, 20th September 2025, from 4 p.m. to 7:30 p.m., I'm going to be hosting a personal finance masterclass, and in it, we're going to cover a range of things. Right from how to select mutual funds, no matter what your goal is. From short-term goals, which are often ignored, like say buying a house, so preparing for down payment for that, how to save for vacations, how to save to buy a car, to even long-term goals like how to save for retirement. Then I'm also going to be sharing with you insider secrets of how to select the right health insurance plan, including how to boost your existing cover by 1 whole crore by spending less than 1,000 rupees per month. I'm going to be sharing with you how you can select term insurance plans and how to plan for your emergency fund, how much should it be, where should you keep it, and everything around it. With the masterclass, you also get access to 8 proprietary personal finance calculators that I actually use while handling real client money. The link to register is in the bio. The seats are limited, so register soon. So let's now move on to the second strategy, the balance strategy. And this is for someone who understands the basics of investing and wants to push their returns higher while again managing risk intelligently. And here's how your 10 lakh allocation would look like in it. 4.5 lakhs gets invested in a balanced mutual fund, 2.5 lakhs in a mid-cap mutual fund, 1 lakh each in a small cap mutual fund, international fund, and gold. Do you notice what I've done here? I have decreased the balance fund allocation from 6 lakhs to 4.5 lakhs, and by doing that, we have decreased the amount of bonds that you hold in your portfolio. Now, that excess amount, 1 lakh of it goes into a completely new type of category, small cap mutual funds. These are companies that are ranked between 250 and 500 in terms of size in the Indian stock market. And apart from that, we also invest 50,000 extra rupees in a mid-cap mutual fund. Now, why are we in the first place introducing small cap mutual funds here? There's a very simple reason. They have the potential for explosive growth, and let me show you here, right? Again, I'm looking at the past 20-year data now, 5-year rolling returns for an SIP, and you will right away see here, right? Just focus on where my mouse is right now. You'll right away see that the Nifty 50 over any 5-year period for an SIP has given 13.1% returns, but look at the difference, right? For small caps, it's 18.2% and for mid caps, it's 19.4%. Now, if I just highlight the Nifty 50 here, right, you will notice something right away, that it's a more flatter line, so the returns are more consistent within that one band. It's not going too high or too low apart from just one instance, but also the number of times that mid and small caps have given higher returns than the Nifty 50 is considerably high. But that also, by the way, comes with higher risk. So just look at the standard deviation, right? 4.3% for an SIP for Nifty 50. It's more than double for small caps and it's almost double for mid caps. So that tells you that when you're investing in these categories, yes, there is potential for higher growth, but it also comes with the portfolio moving more up and down, which is again very beautifully captured in this particular chart. And that 5% extra returns that small caps have generated over large caps creates massive wealth over a long period of time. Just to give you an idea, a 10,000 per month SIP at 18.2% returns would have grown to 2.41 crores over 20 years. And at 13.1% returns, that would have grown to 1.16 crores. As you can see, that 5% return just means more than double the money that has been generated in small caps. That's why we don't want to put all our money in just small caps or mid caps. We want to spread it very strategically. So the allocation here in the balanced strategy, so 10 lakhs invested in this strategy would have grown to 44.4 lakhs over the last 10 years compared to 35.7 lakhs in the Nifty 50. Now this is how this balanced approach would work, right? So I'm focusing on the Nifty 50 here, and you will see once again almost at every point in time except for that very small window middle of 2021 when the Nifty 50 performed better than this particular mix. But most of the time this portfolio has done better. And once again, right, let's look at rolling returns. 13.6 for Nifty 50, we've already seen that. 16% for this particular mix. And again, this has never given negative returns, whereas Nifty 50 for that very small window, right, for that 1 week during the very peak of the COVID crash or the very bottoms of the COVID crash, you saw that negative return here. Again, explosiveness, look at 3%, 3.5% for Nifty 50 over 20%. This portfolio is almost touching 20%, which is wonderful. And finally, the standard deviation, here you will notice it's 3.7. For Nifty 50 and about 4.8 for the balanced mix. As you can see, the returns grow a little, and standard deviation, right, the volatility in the portfolio, the risk in the portfolio also increases a little from 4 to 4.89. Now let's go back to the logic of this portfolio, right? We still have 4.5 lakhs invested in balanced funds, and that acts as your safety net, because by virtue of having this amount in balanced funds, you have some exposure to bonds and it's automatically rebalanced as the markets move up and down. And this exact psychology is crucial. You're still invested in bonds, but now you're getting comfortable with the higher volatility that comes through the addition of small caps and increasing your allocation to mid caps. This teaches you to stay invested when the market is throwing tantrums, when it's moving down, a skill that is worth crores in the long run, and that is the habit that you're trying to inculcate with this balanced approach. Now let's move on to the aggressive approach. Your 10 lakh investment in it would look something like this. 2.5 lakhs would get invested in large cap funds, and by the way, you can also just swap this out with balanced funds. 3 lakhs would get invested in mid cap funds, 2.5 lakhs in small cap funds, and then 1 lakh each in international mutual funds and in gold. If you choose to eliminate balanced funds, then now all your money gets invested in the stock market. There is no harm in having that 2.5 lakh allocation even going into balanced funds, because that gives you about a 8 to 10% exposure to bonds, which is not really going to matter in terms of returns, but it can balance out risk. But regardless of that, you now have most of your money invested in the stock market. Now here, if you notice, 2.5 lakhs gets invested in Indian large cap mutual funds, and the 1 lakh that you're investing in international funds, most of it also goes into large cap stocks. So in a way, if you're investing 10 lakhs in this kind of an allocation, about 3 to 3.5 lakhs gets invested in large cap stocks. 10 lakhs invested in this kind of a portfolio would have grown to over 47 lakhs in 10 years. And here's how it would look like, right, in terms of how it moves along with the Nifty 50. So once again, you would notice now in this case that this portfolio has always performed better than the Nifty 50 on a 5-year rolling basis. And then if you look at rolling returns, they're 16.79 for a 5-year rolling basis, whereas 13.6 for the Nifty 50. The explosiveness of this portfolio, right, again is very critical. Look at this. Over 20% of the time, this portfolio has returned over 20% returns, which is fabulous. If you hold this portfolio for over 5 years in the past, it has never given negative returns. Under 8%, just 4% of the time, right? And that was during this very small window during COVID. Once again, just look at how the Nifty 50 at different times kind of stays within range, right? Whereas this portfolio has the potential for that explosiveness on the upside. But having said all of that, here's what you need to know. This portfolio will test your nerves, because this aggressive approach comes with serious volatility. When I say your portfolio will swing wildly, I'm not exaggerating. Here's what exactly happened in the recent history. From the start of 2018, just look at how large, mid and small caps performed for 2 years, right? So here you go. Let me just calculate. Look at this. Small caps during this window were down by 45%, which is crazy, right? And even if I don't consider the COVID crash, right? Just look at this. They're down by 17%. Just think about it. For 2 whole years, you've invested your money, but that amount that you've invested in small caps is down by 17%. In mid caps, slightly lower, down by about 4 to 5%. In large caps, that would have grown to about 25%. So that is the kind of movement that you just have to be willing to accept if you're investing in mid and small caps. Because for long periods of time, they would not do well, but then they would explode. And that's why we have seen that over entire market cycles, the returns across large, mid and small caps, they tend to get very similar right at the end of the cycle when the crash takes place. And there's a simple solution to sort of avoid this, which is every 2 to 3 years, decide, right? 2 or 3 years, just bring your allocation back to what it was. And this is what I want to highlight, that when you're investing aggressively, you have to be willing to see those periods when your portfolio is not doing well. When people say that you will get 14, 15 or 12% annualized returns, it's not as if you're going to get that every single year, right? There are going to be periods where you get minus 10%, minus 20%, plus 30%. You should be able to handle that volatility, because only when you do that, do you see that 15% or 14% annual returns over a long period of time. Now let's step back and remember something very important. There is no wrong choice here. Which of these allocations or strategies that you select? The only wrong choice is not starting. Start with the strategy that matches your experience. You can always graduate to the next level as your confidence and knowledge grows. Now, before you go, there's one very important way to invest that you can implement here. Consider this if you're investing a lump sum amount or any large sum of money. You don't have to deploy that entire 10 lakhs on day one in these exact funds. That is where an STP or a systematic transfer plan becomes your best friend. Here's how it works, right? Let's say you want to start investing 10 lakhs. You would first invest that in a liquid fund or a short-term debt fund and then direct that particular fund house to move your money into your target funds over 6 to 12 months. Because let's say we are investing in 4 to 5 funds, you would essentially have 4 to 5 short-term debt funds or liquid funds, and you will instruct those specific AMCs to start an STP. Most major platforms allow this no matter where you're investing. And what this does, right, when you're investing in the markets, there are some risks that you take on. One is obviously the market risk, how the markets move up and down. The second is your own mindset risk and entry risk. Because let's say you invest all 10 lakhs on the first day and the markets don't do well for the next 3 months, right? They go down by, let's say, 15%. Now your 10 lakhs essentially has gone down to 8.5 lakhs. With an STP, you're getting different entry points over, say, 6 months. So if the markets are going down, you're buying at lower prices. If they're staying constant, you're buying at similar prices. If they go up though, you tend to buy at higher prices at every point in time. But again, this is not to maximize returns. This is just to make sure that you are in the right mindset. You don't get anxious if the markets don't do well. And you know what? After just spending so much time talking to people about investments, after setting up their portfolios, that is the most critical part. You want to build a portfolio, you want to select funds, the right asset allocation, that just helps you stay invested, because that is really the magic. Just staying invested for 10 years, because that's how your money grows. And finally, right, a very important question, which funds have I selected for each of these categories? Because I've only mentioned categories here, right? So it's a very simple allocation. For balanced funds, I have selected the HDFC Balance Fund. It is the largest balance fund out there, the oldest one. That's why it gets the money in this particular video. Then for large caps, it's straight up a Nifty 50 index fund. For mid caps, a straight up Nifty mid cap 150 index fund. And for small caps, a Nifty small cap 250 index fund. If you want me to make videos on how to select index funds, just let me know below and I will be on it very soon. The international allocation is essentially going into the NASDAQ 100, which is the American Tech Index. And the fund that I've selected here for this video is the Motilal Oswal NASDAQ 100 ETF Fund of Fund. For gold allocation, I've selected the Nippon India Gold Fund. The reason for this is simply because it was the oldest gold mutual fund in India. So I wanted to have data that stretches for longer periods of time, not just 2 or 3 years. And that's why the allocation went there. So there you have it. 3 different strategies, the exact funds that you can invest in depending on which strategy you're going for. If you enjoyed this video, then check this one out, where I talk about how saving your first 10 lakhs is magical and changes everything. And if you haven't done that, that should be your focus. I'll see you in the next one.